Whole life insurance, one of the most controversial topics in all financial planning. You have some people who swear by it. They claim it's a wealth building powerhouse. Others call it one of the biggest financial scams that's out there. So who ends up being right? Well, I'm David Heller. I've been an independent financial advisor for the last 16 years, working with clients to help them not only build their wealth, but also how to protect it. Now, I do have a personal opinion about whole life insurance. I'll share that with you towards the end of the video because I've seen it be used in a lot of different situations. I've seen it be pitched and sold in a variety of ways, but stick around to the end. This video is all about really just taking you through what whole life insurance is, how it works, how do the values actually grow over time, what are some of the biggest myths and maybe misunderstandings, where do critics get it right, and maybe where do they get it wrong? And most importantly, is whole life insurance a good fit for you? So with all that being said, let's get into it. So whole life insurance is really two things under one roof or within one product. You have your death benefit and your cash value. Those are the real driving points. The death benefit is meant to give you a guaranteed death benefit that's going to grow over time, but it's going to last you for your entire life, assuming you pay the premiums. The cash value is positioned and kind of thought of as a conservative investment or allocation that gives you significant tax advantages that a lot of other products and strategies don't have. So let's start from the top. Premiums. Now, you've seen me in other videos go through a life insurance 101 and explain to you very rudimentary how permanent insurance or whole life insurance works. And if you remember, there's 4 subsets of permanent insurance. For this video, we're only going to talk about whole life, which is the most traditional and longest lasting permanent life insurance policy that's out there. So let's talk about premiums. The premiums are going to stay fixed over a period of time that you have the contract or whatever your schedule is in terms of how you've structured the policy when you were setting it up. There are short pay products where you can pay for either 10 years or 15 years or 20, or the more traditional whole life products, which are you fund it to age 65, or you fund it all the way through age 100. Now, the premium is going to go to cover and pay for your actual death benefit. This is a guaranteed amount that your family is going to receive tax-free should you pass away prematurely or pass away at a specific point in time. This death benefit stays in place for the life of the policy and theoretically should grow over time. This is all with the assumption that you keep paying the premiums every single year and you don't let the policy lapse. But that's in turn why the product is called whole life insurance, because it's meant to last you for your entire life. Then you have the cash value, which again, that's the most controversial part of this whole product, I would say. So as you pay your premiums every single year, a portion of that's going to go to cover the cost of the insurance. And then the other portion is going to go to the overall to the cash value component within inside of the policy. Now, the cash value is guaranteed to grow every single year based off of the guarantees that this particular product affords people. It's going to grow tax deferred and then ultimately and theoretically come out tax free should you want to use that particular cash at any point during owning the policy. Over time, the death benefit, over time, the cash value is going to grow and in a substantial way. Now, it's going to take a couple years for it to really start to compound and grow and show some meaningful growth. Again, this is in the traditional way that a whole life product is structured. And the cool thing is you can borrow from it at any point in time. So I've seen clients get themselves into or have some situations that come up where maybe it was a family emergency or they had a business opportunity. I remember that one where someone wanted to use funds, but they didn't want to pull from some of the other assets that they had because they were maybe going to have to pay some taxes on it, like say with inside of an investment account. They didn't want to deplete a retirement account. So they were able to go in and use the cash value as basically a way to borrow from themselves and then ultimately pay it back or maybe not pay it back. So that's one part where I've seen the cash value have some sort of material difference in helping someone when they get into a jam. It's just another bucket of money that they can access. Now, how do the values actually grow? So this is where it becomes tricky, but in my opinion, it's also kind of easy. So it grows in really 2 ways. So you have a guaranteed growth, which is basically a minimum interest rate that is credited by the insurance carrier that you decide to buy a policy from. So in 2025, most carriers are guaranteeing anywhere between 2 to 4% as far as the values having to grow every single year, regardless of what's happening in the economy. And this is an important point as far as how insurance salespeople and agents position this particular product and strategy when advising a client. I would think of the guaranteed growth rate as a floor. Now, what you'll hear most agents and salespeople talk about are the dividends that are credited by the insurance carrier. So on one side, you have the guarantee, which is somewhere between the 2 to 4%. And then you have a non-guaranteed value, which is really in the form of a dividend, which again, nowadays in 2025 tends to be somewhere between 2.5% to maybe 3.5%. These dividends are really determined by how well the insurance carrier is doing from an expense and mortality perspective, as well as how their investments are doing that they've invested in personally. The thing is, with the non-guarantees, which are the dividends, those aren't guaranteed. They are variable from year to year. But many top mutual carriers, who are really the predominant players in the whole life marketplace, so carriers like Mass Mutual, Northwestern Mutual, New York Life, Guardian, Penn Mutual, and then there's some others out there. Those are the ones that have a significant track record in terms of history of consistently paying dividends every single year. And this is something that's going to get played up when you are having the conversation with someone who sells these particular products. They'll show you a schedule of how these dividends have performed over time and how they've withstood financial markets like 2008 and even maybe 2022 or 2020 with the COVID crisis and things like that. Now, what can you do with dividends? So dividends are, you really can do what you want with them, I guess. You can take them in cash if you wanted. You can even use them to reduce the premium or even pay for premiums in future years, or do what most people do, which is to leave them to earn interest. And again, interest is that dividend crediting rate, which is made up of the guarantee as well as the non-guaranteed values. The cool thing is if you leave them, what ends up happening is those dividends wind up purchasing what's called paid up additions. And this is where it gets a little technical, but those paid up additions are basically like mini whole life policies inside of an actual policy. It's almost like they're units. And those paid up additions start owning their own interest as well as dividends. And so this creates that compounding and sort of flywheel effect that makes this particular product and strategy so powerful. So you might ask, well, how are dividends actually determined? Dividends come from one of like 3 different factors. Keep in mind that the insurance carrier declares their dividend or announces that usually around the end of April or sometime in the first week or 2 of November. That's usually when you'll see a lot of the big mutual insurance carriers come out with what they're going to declare as their dividend for policyholders in the upcoming year. And they kind of give a state of the union as to how the insurance carrier is doing and how what their expenses are and how they were able to achieve the returns that they were able to get and credit the dividend that they were able to credit to their policyholders. Because keep this in mind, when you're buying a policy from a mutual company, each policyholder is in effect an owner of that particular insurance carrier. You don't have shareholders or people who own stock. So it's a different structure as far as how the company is structured. And this is something that you'll hear time and time again when you're looking at possibly getting one of these policies. Now, going back to what I was saying before, how are the dividends actually determined? So when the insurance carrier gets a premium paid by a policyholder, part of it, again, goes to pay for the cost of the insurance, and then the other goes into your cash value account. Well, the carrier is basically taking those and then reinvesting your dollars. So the first criteria in terms of how dividends are determined are really through the investment performance by the insurance carrier. Now, keep in mind, this is because of the guarantees and the reserves that they ultimately have to put aside to satisfy all of the requirements that they have from all of the policies that they have on the books, a very, very large percentage, probably somewhere in the 80 to 90% of their overall investment portfolio is made up of high quality, long duration bonds. That's also why you'll see a lot of sales agents talk about how it's a non-correlated asset and it's more correlated associated with some sort of fixed income investment. The other component is the mortality experience. So this means how well the company has done in terms of underwriting, meaning how many claims did they have to pay out versus how much did they have coming in from policies that are on the books. And then lastly, you also have the operating efficiencies and expenses. So this is just from running their overall business as an insurance company. Now, most insurance carriers, just so you have an understanding, are really built for long-term, consistent stability and not necessarily modeled towards growth, which is again why they have such a high concentration in just overall bonds that they own. Whole life insurance, it's a permanent dual threat asset. It protects your family for life as long as you pay the premiums. And you have a very consistent, slow and steady cash value buildup that you can access at any point and use for whatever reason you want. Now let's get into some of the myths and maybe even like the misunderstandings. And again, as I alluded to in the beginning of this video, it is a very highly controversial topic. People, like I said in the beginning, who love it, they love it. And the people who hate it, absolutely hate it. I do think there is some in between, but we'll get into that. So one of the big gripes that people do have is that there's not a lot of cash value early. So again, a lot of this depends on how it's designed. So there's going to be the traditional way, which has a lot of the expenses and fees like that built in to the policy early in terms of the cash value. So you'll notice in a traditional policy, there's not going to be a lot of cash value for what you're putting into the policy in the first, call it 7-8 years. Now you'll have some people who will claim that, modeling a particular policy this way is more advantageous for the actual agent because it produces a higher commission versus something that has more cash value up front and potentially less death benefit. There are some pros and cons to each approach. But again, if we're looking at the more traditional way, yes, a lot of people get worked up and sort of have concerns about how there's just not a lot of cash value early on. So myth number 2 is that it's a terrible investment compared to the overall stock market. So my take on it is that, yes, that is potentially true. But again, it goes back to the overall picture. What is it that you're trying to achieve? What is your current situation? What do you have that's coming in terms of income? What do you have that's going out in terms of expenses? Have you maxed out all of the other buckets that you have the ability to contribute to, say like a 401k, say investing into a taxable brokerage account? Because what ends up happening is that people who do well financially are going to be looking for ways to put money into different buckets to have their money grow and not just be into one specific investment or asset class. So this just gives people like that some diversification. But keep in mind, the reason that people go out and buy a life insurance policy in the first place is because of the life insurance. It's not because of the investment. The problem is that you have sales agents that are out there that's how they're positioning this particular product because of how unique it is and how different it is compared to a lot of the other investment options that are out there. So whole life insurance should not be compared to a regular taxable brokerage account. It's never going to be able to compete with that. It's meant to be a slow, steady growth vehicle with the tax advantages that you normally can't get in other products and strategies. It's not for short-term or safe money. It's meant for long-term dollars. Again, this is all if you're going to look at it from an investment perspective. Myth number 3, buy a term and invest the difference. So this is the classic Dave Ramsey one. And this is one that I hear a couple times during the year. Listen, I can't disagree with it. I think it makes sense. Again, it's all about being situational and understanding what is it that the client is looking to achieve, what is their overall situation, and does something like this make sense? Can they even afford it? But does it even make sense in the overall grand scheme of things? I would say that a big thing I see is that when someone is going to look to buy some life insurance, they're thinking it's just going to be like your traditional insurance policy. You'll pay, $100 a month for, $1 million, $2 million, whatever the amount is. And so when they're sitting with an insurance agent or salesperson, and that person comes back to them with a recommendation and they're showing a very inexpensive term premium to solve for that death benefit that they're looking to have in place, and then they show them how whole life is priced for what you get in terms of the death benefit, you can see that it's like not even close. I mean, you could expect anywhere from 10 to maybe 20 times higher as far as a premium outlay for the same amount of insurance that you could get in a term policy. So it is a much higher, I guess, quote unquote, expense early on. And so I think that throws a lot of people off. And that's also why you get the camp who think that whole life is just bad. It's not good. I think people have preconceived notions in terms of what life insurance should be and how it should work, and that it should not be intertwined with an investment or an asset allocation conversation. And so that's up for you to determine and figure out. I think there's approaches both ways that to me make sense. But again, it's very situational and just understanding where the client is and what they're trying to achieve. I think there's a lot of other misconceptions and things that are out there that I could probably dispel or answer or whatever the case may be. It's just hard to go through all of them here and even sometimes remember them because they just come up in conversations. But I think those are really the main ones. But lastly, who is whole life for and who is it not for? So again, I think as you can tell, my belief is that whole life isn't necessarily good or bad. And it's the same thing with the other permanent products that are out there, whether it's variable life, index universal life, or even a universal life. Remember, there's 4 subsets of permanent life insurance products. VUL is going to be more cash value generation. Variable universal life is not going to necessarily have the guarantees in it, but it's going to have the potential to really, it basically has no ceiling. Index universal is going to be kind of in between, whereas opposed to whole life is going to be your consistent and conservative way of going about it in terms of if you're thinking about it from an investment perspective. But I think whole life can be very good if you want lifetime coverage. Now, I would counter argue that and say it's very difficult when you're sitting with a 35 or 40-year-old and, talking about putting life insurance in place and asking them to see 15, 20, 25 years down the road. I think it's very hard for people to envision that. A lot of times people think they'll be in terrific shape and they're going to do so well in their career, they're not going to need the insurance later on. But that's actually what I think the best value for whole life insurance is, or even permanent insurance, is the fact that you're going to have some permanent insurance later. Fine, you might not need necessarily 3 million or 5 million or 10 million, whatever amount you decide that you need. You can always go back to one of our videos that we talked about determining the right amount of coverage. But I think the people who can afford it and can fund this properly tend to ladder the policy. So maybe they need 5 million of coverage. Let's just say for argument's sake, they buy $4 million of term and they buy $1 million of whole life. Well, at some point that term is going to drop off. And when that drops off, they're going to still have $1 million of life insurance. But that first 4 million or 5 million cumulative will have gotten them through the very liability heavy years that most families have, which is raising kids, sending them to college, and protecting that income in your peak earning years. Also, I think it's very good for people who just want stability. They want to know that it's there. They don't want to have a situation where the insurance carrier comes back to them 25 years later and says, you know what? This product didn't perform well. You're going to have to contribute more premiums. You know what you're going to get from a whole life policy. You know that whatever those projections are in that particular illustration, they're going to be kind of in the ballpark. They're not going to be that far off at the end of the day. Also, I think it's very good for, again, that ability to create another bucket of savings. It's the people who've maxed out their current bucket strategy in terms of how they're saving. And again, I've seen people leverage that cash value in tight situations where they needed to borrow money just for whatever reason. And then whole life insurance is generally not good if you don't have the funds to really fund it and be able to confidently say, hey, you know what? I can fund this for a defined period of time. That shouldn't be a problem based off of the income that I have coming in and where my career is possibly going. Or if they are so, and then the other thing I would say is if they're so confident that they're not going to need the insurance long term, then if that's the case, term is the way to go. But again, this goes now into my personal view of what I was talking about in the video of whether or not I feel like whole life insurance is good or bad. And so like I was saying, in the right situation, it can work. Is it expensive? Yeah, arguably. And when you kind of look at the prices of, whole is going to be more expensive than VUL and IUL. And that's because of the guarantees. But again, you could take the stance of, well, what are you necessarily comparing that expense to? And what are you trying to solve? I think what irks me the most is the fact that there's a lot of agents and salespeople that are out there that are very pro whole life, but they position themselves as holistic advisors. And so I think it's also you need to be very careful about who you're buying it from, what company they're part of, because maybe they're proprietary agents. They're just doing business as another entity, but they're really an agent of Northwestern Mutual or Mass Mutual. So I'm not saying those approaches and these people are bad and that they're giving you bad advice, but they typically are really asking questions and trying to get answers to build that case for why you should buy whole life insurance. And so what I've seen personally is, in my take on it, whether it's right or wrong, is that you have agents, again, that are out there that are just suggesting very lofty numbers in order of funding amounts that could go into one of these policies. And that funding amount is typically not correlated with all of their other assets or looking much farther out than 3, 4, 5 years. Now, I understand it's hard to look into the future, but that's just one thing that's always concerned me. I always took the stance of I'd rather be conservative if I'm suggesting a premium amount because I want them to fund the policy. I've seen a situation or two in the past where someone has overextended themselves, not necessarily intentionally, but it could have been from the influence of the agent or the salesperson, and where they had to make tough decisions early on in the contract just because of the fact that they really couldn't afford the amount that they were funding into the policy. I also like the fact, and I think this goes for all permanent products, is the fact that you can also add on long-term care and add that on as a rider. I talked about that in my last video, so you can go and check that out as well. So I think if long-term care is something that you're looking for in the future or possibly looking for, it's another good reason as to why consider buying permanent insurance, even if it's whole life or VUL or IUL. But at the end of the day, just know who you're buying the policy from. Make sure you do your homework in terms of the carrier and the design of the actual product and policy. Now, all of the mutual carriers, they're all really good. They're all really good companies. You can get into the weeds in terms of looking at, which one will do better versus the other. And again, I don't want to get into that too much here because that could be a rabbit hole we could go down forever. But if you like guarantees and you like safety and security and you're willing to pay for that, then whole life could be the answer. So with all that being said, I hope that you enjoyed the video. If you liked it, please give it a thumbs up. That really helps our community grow. And please subscribe so that way you can stay in tune with all of the future content and videos that we have coming out.
If you're ready to take your financial planning to the next level with a customized approach, feel free to reach out to us. This way we can help determine if we can even help you or even point you in the right direction. The best way to reach out to us is through our website at sandersmith.com. Thanks for watching. For more valuable tips on financial planning, check out those videos here. And if you found this information helpful, please like and subscribe so you don't miss any future content.